Peter Lynch once said that far more money has been lost by investors preparing for market crashes than in the crashes themselves. At first, that sounds impossible. After all, aren't crashes the moments that wipe out fortunes? But Lynch believed the real danger wasn't the market falling, it was investors letting fear make their decisions. Think about it. Every time the headlines scream that the market is collapsing, emotions take over. People rush to sell, convinced they're protecting themselves. Yet history tells a different story. Markets have recovered from wars, recessions, financial crises, and global pandemics. The investors who stayed calm often came out far ahead of those who panicked. Peter Lynch managed one of the greatest mutual funds in history, and he understood something timeless. No one can consistently predict when a market crash will begin or end. If professionals with unlimited research struggle to do it, the average investor shouldn't build a strategy around guessing either. Take the 2008 financial crisis. Stock prices around the world plunged, and fear dominated every news broadcast. Many investors sold quality companies at massive losses because they believed the worst was still ahead. Others stayed invested, continued buying strong businesses, and patiently waited. Over the following years, markets recovered, and many of those disciplined investors saw their portfolios grow far beyond where they had been before the crash. The same lesson appeared during the COVID-19 market crash in 2020. Panic selling happened almost overnight, but so did one of the fastest recoveries in modern history. Those who focused on long-term value instead of short-term fear were rewarded once again. Lynch's rule isn't about ignoring risk. It's about recognizing that fear is often a worse enemy than falling prices. A market crash doesn't automatically destroy wealth. Selling great investments at the worst possible moment often does. So what should you do when markets fall? First, remember why you invested in the first place. If the business is still strong, a lower stock price may represent opportunity rather than disaster. Second, avoid making decisions based on headlines alone. News is designed to capture attention, not predict the future. Finally, keep a long-term perspective. Wealth is usually built over years, not weeks. Peter Lynch believed successful investing isn't about having perfect timing. It's about having the patience to let great businesses work in your favor. The next time the market crashes and fear fills the air, remember this simple lesson. The biggest opportunity often arrives wearing the disguise of uncertainty. The investors who remain calm while everyone else panics are often the ones who build lasting wealth.